Hi, I'm Mike Richter, and today we're going to be talking about how do I get out of debt? And more importantly, is this the right question to be asking? There are different ways people look at debt, and there are different ways that we can address that. I'll be addressing the following topics today in this video. We're going to look at two different major views on debt, and then I'll give you my view on debt and how I place it on that spectrum. Then we'll go over the crawl, walk, run system. It's very similar to Dave Ramsey's baby steps, but there are very interesting twists and tweaks to the system that I've made to maximize effect. And finally, we're going to talk about the financial snowball. It's not just the debt snowball, but we'll realize that the snowball and compounding effect in finance, having to do with intentionality in what we're doing, not only affects us on paying down debt, but also affects us when we are investing in assets as well. Let's get started. So two views on debt. So the first view, popularized by Dave Ramsey, is that all debt is bad. And it makes a lot of sense. I mean, biblically speaking, there's a lot of sense to be made for the statement that all debt is bad, because there are some elements of Scripture that say that the debtor is slave to the lender. And in a way, that is very, very true. I mean, a certain portion of your time that's used to generate the income to pay on your debt, for that period of time, you are enslaved to that debt. There is some truth to it. So, is it you that's personally enslaved to that debt? Well, it depends on the kind of debt, right? The second view on debt, popularized by Robert Kiyosaki in Rich Dad, Poor Dad, he makes the broad sweeping generalization that there is good and bad debt. The bad debts that Robert Kiyosaki puts out there are personal debt on things like expensive fancy cars or student loans or credit cards, things of that nature. Now, my personal view on debt is that debt itself is a tool. It's a lot like a pencil, in that the pencil can be good or is not good or bad as much as it can be used to write good things or write bad things. It can be used to create, it can be used to stab people. I mean, a pencil is a tool, and likewise, debt is a tool. It in and of itself is not good or bad. It's just a matter in how you use it. For example, if I were to use debt to purchase a rental property, the reason why I don't look at that as a negative thing is that when I go to purchase rental property, I purchase rental property at a significant discount so that I have instant return on my money and my cash flow is positive and secure, based on very conservative underwriting that I do for my deals. Because if it's not a great deal, I'm not doing it, because I'm not in the market for good deals or average deals. I'm in the market for great deals. So in a way, it's the house or the property that ends up being slave to the lender, because it's the house or the property that's creating the income. I myself am not directly slave to the lender, because I'm not spending my time and my effort to pay that debt, and in fact is the underlying asset that is paying for the debt. So let's move off of the views of debt thing and look at the crawl, walk, run approach to dealing with debt and building wealth over time. The very first step before anything else is setting up a proper budget. Now, I had put a video up a couple of days ago about your three most important financial statements, and I'll put a link in the description below, as well as a link at the end of this video to that video, so that you can get a budget spreadsheet in that video's description. And the basic idea is you want to make sure that you're telling your money what to do. You are giving your money a purpose and a task, and that is the beginning of the financial discipline journey that you're going to be going on in the crawl, walk, run process, so that you can get out of debt and get into wealth and financial freedom. So after you've got a budget, the next step is to create a baby emergency fund of about $1,000. That way, if a little emergency comes up, it's not going to be a big deal, because Murphy's Law says that if bad things can happen, they do happen. And it tends to happen and be much worse for you if you don't have any emergency savings to deal with those kinds of things when they do come up. So by having this $1,000 set aside in a savings account or in a money market account, something that's liquid that you can touch right away and not have to worry about losing value on it, that's ideal for emergency savings, because honestly it ends up being more like insurance than an investment. Because savings in a savings account, please do not invest money in a savings account. It's not what it's for. You end up losing money over time due to inflation. So for that reason, we're going to use a savings account, knowing that we're only doing it for insurance against bad things happening. So after you have a baby savings account set up, the next step is to list out your debts from smallest to largest and note the kinds of debts you have. And that's going to end the crawl phase of your financial discipline journey. Next, you're going to mature into the walk phase. This is where you start addressing your debts in one of two divergent paths. Now, the really simple approach that can get you quick, easy wins, if you need that to really motivate you, you simply pay your debts smallest to largest. That way you get quick, easy wins, and that can motivate you to do better. You're going to end up losing out on some benefits that we'll talk about in a little bit, but this is a matter of self-knowledge. You have to be aware of the kinds of needs that you have to make these financial disciplines habit in your life, so that you can continue to win with money. And if making a simple pay it smallest to largest works for you, then by all means, go for it. However, if you're looking to maximize your effects and really win with money, I would suggest a different approach. And this approach, it involves looking at your different debts and looking to see if the interest on those debts is tax deductible at all. First. Next, you want to take a look at if the debt is secured, like if you have a car loan. Is the car worth more than you owe on the car? And if so, you might be well served to just sell the car and buy yourself a less expensive car for a period of time until you get your debt cleaned up. That way it'll clean up your debt much quicker, especially if you're in a starter car loan where you have a fairly high interest rate. And then you want to double check at what level of interest are you comfortable with moving on to saving and investing, right? For me personally, there's a student loan that we still have amongst me and my wife. I think it's my wife's student loan, and it's sitting at 2.5% interest. Okay. So not only is it only 2.5% interest, the monthly payment on it is right around $130. And of that $130, about $110 goes to principal and the other $20 goes to interest. I'm fairly comfortable dealing with that $130 a month payment, as it is paying off the principal on the loan very quickly relative to the amount of interest that's being collected. And on the flip side of it, I know that I can very easily use the amount of money that is owed on that loan, and instead of paying the loan, if I were to invest it in real estate, which is something I like to do, I can easily make 8% cash on cash return, even when I'm underwriting the deal very conservatively. And that doesn't even account for equity gains or appreciation or instant equity on the purchase. That is simply cash on cash return. So I can buy a rental property and use the cash on cash return to pay for the student loan and then some. And that's how it works in my world. Another thing to look at is if you have credit cards or other unsecured debts with significantly higher interest rates, even though they might have slightly higher loan balances, you might want to go ahead and pay those off before your lower loan balance items, simply because of the effect of the higher interest rate, because it hurts you more for longer. So that's why you might want to address it quickly. It's kind of like triaging a patient. You might have a small cut on your finger, but if you've got your right arm cut off right at the elbow, and are you going to have the doctor look at your finger, or are you going to have them reattach the part of your arm that's detached from your elbow? Of course, I want to go ahead and get my arm back. That's more important to me because that is causing me more discomfort, that's causing me more pain, and that puts me in more danger over time. But the bottom line is, if you choose to maximize for effect, this is where you have to fine-tune where your comfort levels are in terms of risk, because any amount of debt on your shoulders is by definition risk on your plate. You have to determine how much risk you're willing to take on other endeavors that you're going to be going forward with in investing and saving and things of that nature. So now that we talked about the second way to go in terms of walking, let's follow up with the last walk step, and that's setting up a fully funded emergency fund. And a fully funded emergency fund is 3 to 6 months worth of expenses based on your budget. And once again, this is an emergency fund, so it needs to be in savings or in a money market account, basically something that is insured, because your emergency fund, the whole reason why you have it is an insurance policy against crazy things that can happen in life. It's not there to invest. So now that we've crawled up to getting ready to pay off debt, and then we walked our way through the debt mire, now we get to go ahead and start running and winning with money even more, now that we've grown into a level of financial maturity by paying off our major debts. Or if you're going with the pay off all debts, you've paid off all your debts. Now, the first step in the run phase is decide how much you want to put aside for retirement, and do it. So Dave Ramsey recommends 15% of your gross income to go into IRAs and other tax-advantaged retirement accounts. And if your 15% exceeds the upper limits of what you can put into those different kinds of accounts, then to put it into a separate brokerage from there for the purposes of funding retirement. Whatever the number is for you, the whole point of a retirement account is to benefit from tax advantages and letting your money grow tax-free in the case of a Roth IRA, or tax-deferred in the case of a traditional IRA. We'll talk more about those kind of things and different ways that you can leverage each of those programs to your advantages in another video. But for the purposes of this video, it's just find a number that you're comfortable with in terms of a percentage of your income and put it aside for retirement. And make sure that you make the best use of tax-advantaged vehicles as possible. That way you get maximum benefit from that. After that, you want to make sure that you pay yourself first. So determine an amount of money that you are intentionally going to set aside for the purposes of saving and investing. And that comes right out of your paycheck, and you put it into something that is market-based. And something I would recommend putting it into would be something like an S&P 500 index fund that makes okay returns, provides a dividend over time, and has a very consistent track record, so that you can hold it there for a period of time until you've accumulated enough to purchase other assets that require a higher down payment, like a rental property. So you can say put aside 20% of your income, put it into S&P 500 shares, and then once you have enough for your down payment, sell those shares off, buy the rental property, and then take that excess cash flow and buy more S&P 500 shares for the next time you're going to buy a rental property, while you're still using that 20% of your income to keep buying more S&P 500 shares. So the next step, which is run step 3, is buy wealth producing assets. This is where you buy things like rental properties, you can buy other kinds of mutual funds, you can buy storage units, apartment complexes. There's several different kinds of assets that produce income, so that you can keep pooling that back into your S&P 500 shares so that you can go and buy more assets. Now, all throughout this process, while you're running, this is your opportunity to really live and give. Once you grow accustomed to really managing your money well and investing in cash flowing, appreciating assets that generate income over time, you're going to eventually be able to be financially free, where your income coming from your assets exceeds your expenses, and you really don't have to go and work to make a living. Instead, you get the freedom to work because you want to, not because you have to. And isn't that an awesome thing? That's what we're working for, and what thankfully my family's been able to achieve fairly recently. And the other part of that is giving, because when you give to others, it's a wonderful thing. You get to help people in ways that they may not have been able to see coming. And it doesn't just have to be monetary giving. It could be giving of time, giving of your knowledge, because a lot of people are struggling out there. And if you can help one person to achieve the things that you've achieved at that point, then you would have done them and their family a great service. And that's really awesome. So now let's talk about this thing called the financial snowball. A lot of people only look at this from a debt payoff perspective, but I would look at it from both the defensive paying off debt perspective and the offensive buying assets perspective. I've alluded to this quite a bit in the video already, but the basic underlying concept behind the financial snowball is the snowball can be growing and rolling against you in the case of compound interest with debts that you keep accumulating, and there's pressure to work harder to pay those debts. And there's also compound interest that works for you, where you're pushing the snowball down the hill and eventually gets growing bigger and bigger, and it takes less and less effort on your part to buy at the same level of asset. So the bottom line is, whether the snowball is putting pressure on you or whether you're putting pressure on the snowball and rolling it down the hill is a matter of how much effort and intentionality you are putting into the process. By being disciplined and knowing where you stand on financial matters, you're able to direct where the snowball goes. It's going to be hard at first, but I promise you, once you take control of your life and you take control of your financial future, things will be so much better for you in the long run. Now, let's explain kind of how it works when you're paying off debt. When you're paying off debt and you've got monthly payments associated with your debts, like a credit card or a car loan. So say your car loan is $300 a month. Well, once you pay off that car loan, you could take that $300 a month you were paying on the car loan and put it onto your next debt. Say another car loan that was $350 a month. Well, once you are paying that payment that you were paying and all the additional payments coming from the previous debts that you've been paying off and all the extra money you've been trying to funnel onto your debts, that next debt gets killed off so much quicker. And then you can take that additional $350 and then put it to your next debt. Or if you're at the point where you're comfortable with the amount of risk that you've got on the debt side of the house, maybe you have this very low interest rate loan that isn't really bothering you financially. At that point, you get to start using the financial snowball on the other end of it, where you get to pile that additional $650 plus into buying assets. So first, pooling into your S&P 500 so that you can amass funds enough to put a down payment on an income property, so to speak. And then once you have that income property, that residual cash flow that comes in month after month after month, you can go ahead and put that right back into S&P 500 shares along with that extra money you're still putting into S&P 500 shares. That way you're purchasing assets faster and faster, and then that gets you closer and closer to financial freedom every single month. And the cool thing about the S&P 500 shares is quarterly they pay dividends as well, and you can have those dividends reinvested. So it just makes the snowball go that much faster. So let's go ahead and recap real quick. We talked about two views on debt. The Dave Ramsey side of the house, where he says that all debt is bad and that you got to get rid of all of it before you can move forward in your financial future. And we've also got Robert Kiyosaki that says there's good debt and there's bad debt. Good debt is things that you're using money to buy appreciating assets that create money for you in excess of the debt amount. And bad debt are things like car loans that are going to extravagant cars, student loan debt, credit cards, any kind of store card debt, things like that. Basically, buying stuff we don't really need just to buy stuff. Then we also talked about the crawl, walk, run approach. And the different steps in the crawl phase were first, setting up a budget. And the reason why you set up a budget is so that you tell the money what to do and don't let the money control you. That way you have enough money at the end of the month and not worrying about not having enough money to get you to the end of the month. Next is the baby emergency fund of $1,000 just to be there in a savings account or a money market account just in case something bad happens. And if something bad does happen, go ahead and take from the emergency fund and refill it as soon as possible. Now, one quick thing is if you have an income of $20,000 or less, you can elect to have a smaller emergency fund of, say, $500 and then start tackling your debt from there. But at that point, if you have a $20,000 income, you're having less of a debt problem and usually more of an income problem. So finding ways to generate additional streams of income would be a much better benefit to you than to try to scrimp and save every little penny. The next part of the crawl phase is to list out your debts, smallest to largest, and to make sure that you have any accompanying information like interest rate and what kind of debt it is handy and available to review. Then you move on to the walk phase. And in the walk phase, you decide out of one of two paths. Either the really simple path of pay down all of your debts from smallest to largest, and you take all the payments that you were putting at the smaller debts onto the bigger debts as you descend down the line, using the financial snowball idea to make the payoff go much faster, to get you to the point where you can start investing. Alternatively, at the first step of the walk phase, you can make intentional decisions to maximize your benefits, like deciding to pay off higher interest rate sources of debt before lower interest rate sources of debt. Also, to take a look at whether or not some forms of debt have tax deductions associated with them. And if they do, maybe you might want to pay off other debts first because you have advantages that kind of blunt the effect of that debt on you because you can deduct it off of your taxes. Now, that only matters if you itemize on your taxes. If you're only taking the standard deduction, then disregard that altogether. The fact that it's tax deductible doesn't mean anything to you at that point in time, unless it gets you to that threshold where you're going to stop taking the standard deduction and start itemizing, which I would highly recommend finding ways to itemize and get you to that point. That way it lowers your tax liability in the long run. Now, after you either pay off all your debts entirely through the one path on the walk phase, or you get to the point where all the debts you have left over are debts that really don't negatively affect you too much. Like in my personal case, that student loan debt that's at 2.5% that I'm only paying $20 in interest every month. It's not a big deal to me because I can just invest in a house and make a lot more money than that $20 that I'm losing. Then you move on to the run phase, where you work on the second step of the walk phase, where you fully fund your emergency fund to 3 to 6 months worth of expenses based on your budget. Once again, in a money market account or in a savings account. We're not investing the money. It's just an insurance policy against bad things happening in our life. Next, we move on to the run phase. Step 1 of the run phase is to decide how much you're going to fund retirement and do it. Set up your IRAs. If you can qualify for a Roth IRA and it makes sense to do that, by all means, you should probably look at that option. If it's going to be traditional, then set it up. Make it so that it automatically goes every month. That way it's set and forget, and you know that it's happening, and you don't have to worry about it. After that, make sure that you're paying yourself first, so that that additional money that you were paying on your debts can then go and funnel into paying yourself first and pooling into an S&P 500 index fund account. That way you can accumulate assets faster to buy other income creating assets, while at the same time moving on to run step 3, where you're buying wealth producing assets, and once again utilizing the financial snowball concept to have all of the various income sources from all of your investments pool into the S&P 500 account. That way you can buy more income producing assets faster and faster. And finally, we get to run step 4, where we live and give like no one else. We live like no one else just because we achieve a sense of financial freedom by getting to the point where we have enough passive income to exceed our monthly expenses. And when that happens, you get to unleash the magic of doing what you want with your time instead of working because you have to. And that's a very special thing. And we also get to give of our time, of our resources, of our knowledge to help the next person out, because we have a responsibility to pay it forward once we've achieved a certain measure of success. And we also talked about the financial snowball concept itself, the fact that compound interest hurts us really badly when it's working against us and is fantastic when it's working for us. And basically, the compound effect of our intentionality in telling our money where to go helps us in the long run. First, by paying down and paying off our debts, and secondly, by investing into income producing, wealth producing assets that help us achieve financial freedom much faster than we would otherwise. So, if this video was of any value to you, by all means, go ahead and give it a thumbs up. I'd really appreciate it. If you'd like more content from this channel, by all means, go ahead and hit that subscribe button. And if you're interested in modifying your notification settings so that you can get this content as soon as it comes out, go ahead and hit that little bell icon right next to the subscribe button. That way you can set your notification settings to where you're comfortable with. And finally, if you've got any friends that could really get value from this content, I would encourage you to share it with them. It's free, so that makes it widely available and widely accessible to other people. And also, if you've got a question, by all means, go ahead and put it in the comment section below, and we'll chat about it as we go down and have a conversation. This is about the time in the video where I remind you to have a fantastic day.